Hi, I'm Danica Swanson, CPA,
And I'm Megan Richardson, LTP.
and together we own and operate BB Tax and Accounting in Clackamas, Oregon, which is just outside of Portland, for those of you that are not from the local area. And today we want to talk to you about some things concerning homeownership and what you need to know about the tax implications of that. Um, just about the only people that don't need to listen to this discussion are the people that are going to buy their house and live in it until they die and never sell it and never rent it and never use it for business. Some myths that we've heard in regards to home sales, things that you might have heard from a variety of sources, probably none of which are a tax professional. You might have heard these from
Mother-in-law,
your dog walker,
your housekeeper,
your realtor.
maybe even a lawyer.
These are not good sources of tax advice.
Generally speaking, you're going to want to talk to a tax professional.
And while we are tax professionals, we're probably not your tax professional.
So it might be a good idea that if you hear anything in this video that you think applies to you, or if you're considering selling your home, talk to your tax accountant about the possible ramifications on your tax return.
Also, this is not an entire discussion of the tax code. This is very broad and general. So if you do have follow-up questions, you do want to talk to your tax professional. Let's see. My favorite myth that I've heard is if I sell my house and I buy another one within a certain amount of time, I don't have to pay tax on that.
Well, this is a confusing idea because it used to be the case for individuals, and now it's still the case for businesses. However, if you're just selling your main home, it doesn't count. You cannot do a trade-up like that and get away with it.
Yeah, there's no like-kind exchange for a personal residence.
No, that's gone.
What's your favorite?
Another old one, I think at some point in time in tax code, it was a one and done deal where you could get one exchange in or not one exchange, but one primary home sale in a lifetime. And then that was it. You didn't have any other opportunity to do that. The fact of the matter is anybody can get a gain on the sale of their primary home tax-free up to $250,000 for a single person and $500,000 for a married person, as long as you've lived in it for 2 years.
So if you time it right, you could do this many times in a lifetime.
Over and over again. You have to live in it for 2 years, but the hard part is actually making a gain on the sale of a home every 2 years, because that is hard to do.
Yeah, unless it's a really good market, even if you don't meet that time period requirement, by the time it's all done, we may not be talking about a gain. We might be talking about a loss, which is also another myth we've heard. You cannot deduct a personal loss. So
even though you may have to pay tax on the gain on a sale of a home, you can't take a loss on the sale of a home.
Another one that I hear a lot that can be detrimental, especially if it's gone on for years, is if I don't claim depreciation on the house I'm renting out, I won't have to recapture that depreciation when I sell it 30 years later. That can really hurt. So if you're thinking about renting out a house that you might sell down the road someday, you should definitely talk to your tax professional.
A lot of people think that, say for example, they rented a house out for 15 years and they've depreciated half the value of the house already, and they don't want to pay any gain on the sale of the house, that all they have to do is move into that house for 2 years, and they get away with it. Why is that wrong, Danica?
You still have depreciation recapture.
Yeah. Even if you didn't take depreciation on that rental property, the IRS charges you for the depreciation that was allowable. So either way, you're going to wind up paying recapture on any property that you had out as a rental. So if you rent your house out, if you have a house that you owned for a while and lived in, and then you rent it out, and then you decide to sell it, and then you come talk to your tax accountant, you're going to have a bad day. You're going to have a really bad day.
So you should talk to them before you rent it out.
Yes, for sure. Maybe even talk to them before, if you didn't get to them before you rented it out, talk to them before you decide to put it on the market. Because there's a price tag to that people don't know about, and I'm telling you, it can get ugly. Another myth that people have is that if they are eligible for the exclusion, say they call a tax accountant and ask whether they have to pay tax on this sale, and the tax accountant says no, then that's it. They don't have to do anything. They don't have to tell the IRS. It's nothing to do. That is rife with problems that you can get into.
It's probably going to trigger a letter. You may not end up paying any tax, but you might end up paying a tax professional to respond to that letter and file the appropriate forms. Another thing we've heard is that if you own a home with a spouse and one of you passes away, you lose the exclusion or part of the exclusion, and this isn't true. There are some rules that you need to know about, but generally speaking, that doesn't mean that the exclusion is lost.
No, actually, there's a lot of opportunities to basically adjust what you would call the purchase price of the house after your spouse passes away. And if you sell the house within 2 years after your spouse passing away, you can include their exclusion on your tax return. So, we don't want to end with what not to do. We want to end with what to do. So, first of all, what are the rules about selling your home?
Well, very generally, and this is going to apply to most people, if you live there at least 2 years and own it at least 2 years, and you're single and the gain is less than $250,000, and if you're married and the gain is less than $500,000, you're generally not going to have to pay any tax. You just need to make sure you report it properly on your tax return.
But you still want to tell your tax accountant about it.
Yes.
And save records. Usually tax accountants are telling you when you can throw things away. And I'm here to tell you, when it comes to your house, if it's a major improvement, don't throw it away. Hold on to it.
Yes. If you get paving done, if you get that roof replaced, you're going to replumb the whole house, things like that. When in doubt, save it.
That's your favorite.
That's my favorite. When in doubt, save it, because you just never know if you're going to need it. And it's a whole lot easier to drop a receipt in a file than it is to try to find it 20 years later when you're selling your house.
I shudder to think what your file cabinet looks like.
Oh, do you want to come over and see my file cabinet?
No, I'm scared.
Okay. Good advice is so much better than bad news. I would prefer that somebody call me and say, I'm thinking about doing this, and then we can talk about it before you actually do it, than for you to come see me when it's tax time and have to deliver you bad news and possibly a big tax bill.
If you have something going on with your house that may result in a gain or some transaction of some sort, talk to your tax accountant. If you don't have a tax accountant, find a tax accountant. If you want to ask us a question about home sales, you can always put that question in the comment section.
Or you can contact us on our Facebook page, facebook.com/AccountRants.
And if you feel super nerdy and super smart, you can always just Google IRS Publication 523.
That's if you can't get to sleep at night.
Yeah, don't do that. Call us.